Welcome. I'm just gonna give our intro and then we'll just chill for a minute and let people kind of roll in. But today is
Okay.
Thursday, April 16th, just after 2 p.m. EST. That's just after 3 p.m. Brazilian time. And damn, doing it that way actually messed me up. And 6 p.m. UTC, if I'm not mistaken.
Mhm. Mhm.
Yes. All right. Good. I had to restart my computer for the stream to get my avatar working again because of that OBS issue we always run into, and,
Mhm.
it turned off my clocker. I have this app that, like, tells me all the times, so it makes it that's why I'm so good at it, Marty. I have in my this is the alpha, right in my status bar, I have all 3 of the times. But, okay, we'll chill. I shoulda I wish we had the spaces feature where I could just put on some music and,
Yeah,
mute everyone.
let me just post this all over.
Dun, 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 dun. Dun, 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 dun. Let me just retweet. Denton, you want to put it in the options chat, please?
Yeah.
I'm trying to see if it makes a difference if somebody else posts it besides me. And your keyboard sounds nice. Little mechanic.
Uh, top ray switches.
Today we'll just keep it light. We're gonna test a few things. See what that book. Everything is full. My body's ready. Denton, have you taken any combo trades? Because look, somebody's been aping some micros here. We had a bunch fall off yesterday, last night, or this morning, and then this guy has been aping some.
No, I did before, but this was not me.
Yeah, Algo says it too. He can hear your cherry keyboard.
Yeah, I
I'm
can hear
done.
the
I
cherry
don't. I
keys.
got nothing else to type, guys.
Alright.
And it's not cherry. It's top ray.
Don't worry, I'll take over for you.
All right. Do you want to start?
My keyboard. All right, so yeah, we've got some people starting to file in. So today we're gonna just kind of go over combo trading on Cayenne. To some people, this may be a brand new topic or something they haven't even touched when it came to the exchange. Talked to some people and they're like, "Oh, I've just traded some perps," and other people have just traded options. So we want to take you through our combo page, show you how to actually trade combos. Um, what's special about our version of or how we route our combo trades, and some other features of the exchange while we're kind of perusing around.
Yeah. I mean, I'm happy to take you guys through it. So this
Alright, go
isn't
ahead.
the
Take
front
us over.
page.
You've got your screen up.
Can you see it?
I can see it. Yeah.
Okay.
Yeah.
All right. Cool. This is the order book. This is going to be on May 1st. I think when you come in, it's now ETH. You know, it's like the ETH book first, but you can see price has moved a lot. There's a lot of 99 Delta stuff. You know, nobody had traded any 1600 calls or 1600 puts, so we're not quoting these super wingy stuff. But I think that's what comes up when you come to the front page. I think that Bitcoin's a little better. It shows the book a little bit more, and you know it's worth some real money versus you know a couple bucks here and there, right? This is $2,700, $1,800, $1,000. Um, for people who are new to options, options are the best way to express any sort of payoff that you could imagine. You can go long or short directionally. You can bet on a specific range. You can get upside for free, but free meaning maybe you get paid to put it on, but you can get knocked out later. You can end up losing money if it goes too high. You can sell calls, you can sell puts, you can create any sort of payoff that you want. You can even create a perp kind of position with options. So we're going to go through that a little bit today. And if this is a little scary or a little uninviting, I'm here to hold your hand, or at least try to.
Thank you, Daddy.
I'm trying. I try, you know.
That's
That's what we've always tried to do. You know, everything's for free. We did the academy. The options chat is free. My DMs are open. You know, I do the newsletter for free. Everything's out there for people to absorb as much knowledge as they can. But I still think that people confuse options with like zero DTE options, where there's the payoff is just up or down. You know, I'm just going to gamble today, versus like, okay, I'm actually really gonna build something, build a strategy, and get a good payout. There's some simple ways that we can go directional. What's better? Is that any better, or do we want the dark for the stream?
I kind of like the light mode.
I was gonna say I kind of like the light right now, and that that's a lot coming from me. I
look like that.
Yeah,
we need like a mid dark, you know.
I've been
Like
starting
light,
to take I've
this
taken the
way.
light mode pill. I don't know what's happening to me, but I'm kind of enjoying
yeah,
it
me too, dude.
lately.
I don't know why.
It's spring. Spring for you guys, right? Spring is coming. Maybe you wanted to get you know, some light in your eyes.
I do
before I go, just
so that might be why.
That might be why. Yeah. We had a bunch of stuff fall off. For anybody who's new to Cayenne, Cayenne is an options first platform, but there is built-in portfolio margin, and there are perps. Perps are going to be a little bit different than your normal, you know, drag the leverage bar and ape directionally. Perps are much better to use as a hedge, but you can still go directional, right? So we've been doing about $1 million notional a day. That's perps and options included. That's about 10 Bitcoin contracts every single day. You can see my book here. Let's see what we got. Some guy bought a little put, another guy bought a little put, another guy bought some puts, some guy sold me a little bit of calls. And then some people here you can see have put on some little call spreads, man. Look at this, 72, 74 call spread, 75, 78, it looks like, and 76 and 80. You know, we're on the other side, and he's winning. Whoever is taking these call spreads or these spreads are winning, versus the guy here who's just taking directional bets is losing a lot. Okay, it's literally worthless.
So they're still trying to get puts. They're still.
Yeah,
they
it's
still
literally
don't believe this
worthless.
might.
Yeah, they still don't believe like that directionally trading options with just one leg isn't the right way to go. And definitely buying out of the money options in a normal market move, that they don't have any intrinsic value, right? So if we bring this down and we look at, it's 75K right now, and you're like, I think it's going to go 82K by May 1st. That's 2 weeks away. That's sure, it could happen, but you know, the odds of that happening are roughly 12% that it ends up in the money. Like it's just not going to do too well. But if you were to buy something here like 72K and buy this call, sure, maybe it's a little more intimidating because it's $4,000. It has value, right? It's you're already in the money, $2,500, let's call it. You're just overpaying a little bit. And if it starts to pop up, you're actually going to make more and more money in a normal market move than you would buying out of the money options. That's just step one, right? And we're going to go through combos, and we're going to go a little bit more in depth here. But if you're buying options directionally one leg, buy in the money, or at the money or deep in the money, a little bit in the money, not too deep. This is a little crazy at 14K, but this 4K one, or this one's already $500 in the money, and try that for once. See how that works out. You'll probably make more money. Going into the combo, you can do 6 legs, which is a little extreme, but just got kicked. It's a little extreme, but sometimes maybe you want to do a condor. It's 4 legs and add a perp. You're at 5. Maybe you want to get out of a few positions at the same time. You can build it all here, right? You can add perp. You can add as many legs as you want, and keep going.
Let's say someone sees that stocks are like near all-time high, and he thinks Bitcoin is going to catch up, but he's not 100% sure. Like, what kind of trade would you do with like a slight bullish bias?
A slight bullish bias. Let's pull up the chart. Like what do we want to say? Like it goes to 80K or something?
Yeah.
Okay. All right, we can do this. So we think current price is 75 or 74.5. We think it's going to go to 80. You can create a call spread. So a call spread is you're buying one leg and selling the other. Your max loss is the debit paid, which will go through here in the leg price. It's literally subtract one from the other. And then your max gain is the width of the spread of the strikes minus your debit. So whatever this number calculates to, right? So if we think 75 and we're going to go to 80. So at the top end, we think it's going to go above 80 by May 1st. Something like this, right?
Yeah.
With a call spread, you're buying 1-to-1, keeping it simple. You're buying one and you're selling the other. You're not doing 1/2. You're not doing 1/1.1. To create this payoff, you're just doing a 1/1. They're both calls. They both have the same maturity. And we have this interesting payoff, right? So it's just a little, you can make this anything you want. This could even be 79,000 and it can be cheaper, or 78, I guess, in this sense. And it would be cheaper, but you really need price to move, and you really need it to get in between 78 and 80K to cash. And you need it above 80K to cash 100%, the max profit, right?
Mm-hmm.
So in this example, we're mega bullish. We think it's going to 80K. It's going to 85, but we don't care that it goes 85. We just want to get paid, right? So we're going to buy 178 and we're going to sell 180K. Let's just round this off to $1,000 and $500. Okay. So the spread here is 2K. Costs us 1,000, or sorry, costs us 500. 1,000 minus 500. Our total debit here is 500, and the spread is 2,000. So if the price is above 80K at expiry after May 1st, then we spent $500 to make $2,000. This is rough math, right? It's a little bit different because of these extra couple bucks here. But this is a very simple way where you just spent 500 to make 2,000 instead of you just spent 1,000 on this 78 call, and you needed to go 78K plus 1,000. You needed to go above 79,000 just for you to break even. That's a horrible payoff for you. You needed to go $5,000 basically. Just for you to break even. That's a horrible play unless today price really starts moving in your favor, and then you're able to cash. But if you hold this every single day, you're getting cooked. You're getting absolutely cooked in theta, right? So if we remove this,
so the spread makes the whole thing worth it. If it does move even.
And if you're in your range of 78 and 80, you still get paid out a little bit, but you really make that $500 to $2,000 profit or whatever, $1,500 profit, 2,000 minus 500. If it's above 80, if it's between 78 and 80, you still get a nice payout. If it's below 78, you're out of luck. I wanted to show this here. So if you bought one call option, just a call option, it costs you $1,000. You needed to go 78K plus 1,000 spent. You needed to go to 79,000 in 2 weeks just for you to make $1. Anything over 71,000, then you start to cash at expiry. This is horrible. You're paying $71 a day to me. Every day, this will continue to go up until that this $1,000 becomes absolutely worthless, and you paid me this $1,000. This is never, I'm not going to say never, but it's a low chance that it's going to be 78,000, 79,000, right? That you need to that you needed it. If we go back and build that same one that we had May 1st, we had 78 and 80, and we go back to 1 and 1, right? It's going to cost us that same $500, but a theta, you're only paying $14 because that's every day. It's not like a funding hourly. It's a continuously moving number, and theta's always in dollars. I think that's something that people forget. Theta's always in dollars. It's constantly going out of your premiums. Constantly. It's not like 1 hour every day funding or 8 hour every day, 8 hours multiple times a day funding. You pay a funding. No, this is just time decay, and we'll slowly tick you out, right? We need to add a little payoff graph here, right? But basically, in between 78 and 80, you cash. Not sure how much, but depending on where it lands at settlement, if it's 79, you're gonna win a little bit. If it's above 80, you make $2,000 minus 500. You make $1,500. You spend 500 to make 1,500. That's pretty good, man, right? Versus losing $1,000. So that's a simple way to put a directional play on options. You're like, I think it's going up. I don't know how much. I'm willing to spend $500 to make 2,000. Now, the wider you make this spread, the more money you're going to make, but also the more money it's going to cost, right? So this is 74. So, pretty much right at the money. A little bit above, but now the spread is $5,000, right? It's going to cost you a little bit more, right? It's going to cost you 22. What is that in my head? Exact. It's going to cost you like, what is that? $1,700?
Yeah, like 17.
Yeah, $1,700 to put this on. But if it's between 75 and 80, you're going to win a little bit. Maybe you don't win 5,000, but maybe you win 1,000. Maybe you win 1,200. So you spend 17. But now it's a little easier, right? But you spend 17, and if it's above 80, you make 5,000. That's insane, right? That sure, you could 8 per $1,700 on 100x leverage, and if you hit the lottery, woohoo, great. But that's not really what options are for, right? I'm not trying to hit a home run every time. I'm happy to have a defined risk profile or a defined profit and loss, right? I spend 17 to make 5.
A wick isn't going to take you out.
And if it goes to 77K, 76K, you make a little bit of money. Maybe you're not making 5K, but you're still in profitability. And your odds of this hitting are higher because it's closer to at the money, but you spend a little bit more, right? The debit is a little bit more. You're buying this and selling this. I guess we could make it a little more clear here with that you're selling. Maybe there's a little negative and then a payoff graph or something, right? But this is a very simple.
About adding the payoff chart.
Because I can see it, but people are like, what am I looking at, right? So this is an easy way to get a directional play. You're putting on a spread. It's going to use less of your margin because you're not just spending $2,200 here, right? You're spending $1,700, but you're long a call and short the other, and your max profit is after 80K. That's very simple. You can do it the other way, where a put spread, same thing down. You can do this dailies, right? You can do this weeklies. You can do this monthlies out to May, I guess. You can do it. Put spread, same thing. So put spread May 1st because it has some juice in it. And which that was a little, this should be flipped, but okay, same thing. 75K. Oh, we can make it 74 and 72 or something. A 2K spread. It's going to cost us like $800. We're going to spend $800 to make 2K. If it's below, simplest way to do it is if it's below 72K on May 1st, we make 2K, we spent 800. That's an amazing return. You just took a directional play on options. You didn't just get burned to shit on theta, and you made some profit, right? And your theta is $4 a day. Not, look, if I knock out this sell, you're paying me $82 a day. You were just paying me $4 to still have directional bias, to still get paid if it goes down. And you, instead of paying $82 a day now, you were paying $4. So the same thing can happen with the call and put spread. It's always 1-to-1. It's net or whatever, it could be 2-to-2, 100 to 100. That's okay. But it's not anything wonky. You don't want to change this. We'll get into that a little bit more if we wanted to change it, right? The next way to do it is, it's a little more risky, and this is where I wish we had the little payoff graph, but let's change it back to May. We think it's we're going to buy whatever at the money, basically. It's expensive. And we're like, man, I don't want to pay $2,700. I know it's going to go up, but I don't think it's going to go above. I got to play with the numbers here a little bit, but yeah, that's fine. Okay, just for simple math, it's going to go up. I know it's going to go up. I'm confident it's going to go up. Maybe I'm not that confident. I think it's going to go up. This is a great way to do this. I think it's going to go up. It's going to cost me $2,700. I don't want to spend $2,700, $2,800, but I also don't think it's going to go above 78. So in this example, it's like a 1/3. It's a ratio spread. You can get paid a credit to put this on. It is a little more risky, and I wouldn't advise it being your first options trade here. But let's go through it. Let's just call this 2,800 and this 1,000. So we're going to buy one for 2,700. That's our debit, but we're going to get a credit for $3,000, right? 1,000 times 3. So it's a 1/3. It's a nice ratio spread. We're getting paid the difference here, 27 and 3,000. We're getting paid $300. Okay, in this example, we're collecting $300. Okay, and we're also collecting theta every day, but we're collecting $300 to get upside exposure, and we're putting this on with a simple 1/3. How this payoff works, let me try to work through it. But if it's under 74K and this thing goes to $10, I don't know, if it goes to $5, anything under 74, you collect $300 no matter what, right? You collect this difference here. Now it's 200. Let's call it. You're collecting $200, $300, no matter what. If it goes down to 50K, you didn't risk anything. It doesn't matter. You still collected $300. You're always going to collect $300, no matter what. If it's between 74 and 78, you have you get paid. Okay, depending on where it is at expiry, you get paid. If it's exactly around 78K, you get paid a lot of money. This is where the payoff graph really comes in, right? You collected 300 or whatever, 200 in this. Your max profit zone is in between the legs. And if it goes above 78K, so I guess I misspoke there, right? Your max profit is in between the legs. It's not at 78, right? But if it goes above 78, you have infinite loss because now you're short 3 calls, not 1 and 1, right? This is where you're got kicked off again. Where you're there we go. This is where picking your plays and maybe widening this up a little bit more. Because you're like, okay, 2 weeks, is it really going to move $5,000? I don't know, but I don't want to pay $2,800. I still want upside exposure, but if it goes above 78K here, you're absolutely screwed. You need to start delta hedging as soon as possible or close. But if it's really ripping, like from today, if it just starts ripping, you are in a loss because you're short 3 calls. You want it in between 74 and 78 at May 1st. So if it starts ripping right now, you're going to be in a big loss. You need margin to cover that. Every day you're going to tick off 131. It's going to keep increasing over and over because you're short those 3 calls. And your max profit is in between 74 and 78. This is a way to get upside. You can put a downside too, but upside exposure without paying for it. But it doesn't mean that it's free. It means that you have unlimited risk on the top end. You need to size accordingly. You don't want to blow up. Sure, you collected $300. Sure, you got free quote free upside, but there is a risk if it goes above 78. You're absolutely screwed. Okay. You can do this too, like with size 2. So you're like, okay, I want upside exposure. Same thing, 2,800, but this is 2,000 now. You just paid 800, and you get a different payoff, right? This is where that chart really comes in for the visual learners here, because we know what we're saying, but it's harder for people to visualize this. Denton, you have any questions on this one by
do you know
two
if they're
or
building
1
that
by
right
3?
now?
Yeah, they're building a lot of stuff for the front end, man. They're building the payoff graph. They're building in portfolio the downloadable CSV for all your positions. They're building the P&L chart, weekly, daily, overall, right?
So what if someone thinks that we're just going to keep grabbing like between 70, 76K? What would you do then? And he wants to just profit from the range,
Mm-hmm. You can do a 4-legged option. I don't want to overcomplicate it too much, but let's say you can sell it, right? You can. I guess you could sell it. Let's do both sides, right? So we think it's we think 74 is vols are crushed, right? Vols in free fall. Iran is going crazy. The Middle East is whatever. World War III is coming. We don't know what direction it's going to move, but we know it's not going to stay here. Okay, this is expensive. Okay, this is very, very, very expensive because you're buying a call and buying a put at the strike, same strike, but you're paying for both legs and you're paying theta on both of these legs. This I wouldn't advise either to do too long. We can bring it in tomorrow. Okay, that's a little so thetas. You're gonna get hit on theta, right? But we know it's gonna move from 74 fast. Maybe you wanted to put this on exactly when it was at. We can do that 74.5. It's pretty much 74.5, right? We're gonna pay $900 here for this one, and in one day it's gonna be worthless. But we think the kaboom is happening, right? The nuke is coming, but we're just not sure which way. Maybe there's FOMC, maybe there's a nuke coming, World War III, and it's going to happen by tomorrow, and we're sure of it. Okay, this is a horrible play to do into like an earnings or FOMC or something like this, because this is usually already priced in, and this is priced correctly, and you really need an outsized move to hit or to cash. This one, you're going to spend $800. It's pretty much worthless tomorrow. You're going to buy 1-in-1, same buy, same maturity, same strike, and it's gonna, if it really goes, nuke or pump, you're gonna get paid. You didn't know which way it was, right? The other way to do it is you sell the same, and you're like, it's going to be exactly 74.5 tomorrow. I know it is. Okay. I know it for a fact. I'm going to collect that $800. I'm not going to pay $800. Mind you, this takes a bunch of margin to sell Bitcoin contracts, because Bitcoin's, $70,000 now. Bitcoin's not where it was, when we started, but you can do this on ETH. We can make it. We can try this one on ETH to see if it's cheaper. There we go. Yeah, 2350. Is there a 50? Okay, that's a little closer. Okay, great. We're gonna spend nothing, $50. If it absolutely rips, and you can go as much as you want, right? You can go 10, you could go 100, whatever. So, 160 and 270, $500, or you can pay in one day all that to me if you want. If you really think that it's going to move, or on the other side, you sell both legs. It's much cheaper because the contracts are $13, not $1,000 or $600, and it's going to stay exactly at 23.25 at expiry. I know it for a fact. So this kind of looks like a triangle. I need like a whiteboard, kind of like a. I need like a little whiteboard
You need like a drawing too.
Yeah, I need like a tablet here, but it's a triangle, okay, with 0 in the middle. In this scenario, if price goes to 2,000 to the downside, you have max loss on the downside, and if it goes to 3,000 on the upside, you have unlimited loss. Okay, but in this top triangle, in between this range, you get paid. So depending on where it is in the range, you really want it at 23.25 tomorrow for your max payoff. On the other side, if you were to buy it, you don't want it in this little range. You want it to go to 3,000, and you want it to go to 2,000, or whatever, 24 tomorrow, or to 22 tomorrow. You really want that move right now, right? This is a simple. It's when would I buy a straddle is really hard to say, because it's usually priced in, like into an earnings or into an FOMC. Like, it just is expensive. You're buying both legs. You're better off trying to pick a direction. And you really wanted to just pick a direction in this one. The other one is a strangle. So this is at the money. Straddles are usually at the money. You wouldn't buy a straddle at 2,600 and a put at 2,600. This doesn't make any sense. It needs to be at the money, near the money, right? Strangle is kind of like this. It's selling an out of the money put and an out of the money call. Usually you want this in the same range. So if this is 2,400, you would want $100 here and $100 here, right? You want this in the same range. And of course, it's worthless tomorrow. It's not going to hit. It's 80 cents. So maybe you sell this one. So in between 2,200 and 2,500, you get paid, but you're only going to get paid, 80 cents or something. Like, it's just not worth it on one contract, right? If you had 1,000 contracts, sure. Or if you wanted to bring this in, they're both out the money. You're going to collect less premium than the straddle, but you get a way wider range. Instead of like a triangle, it's like a big U-shape payoff graph where you still have unlimited risk on both ends outside of these bands, outside of these ranges, but you have a more umbrella range than I need it exactly at 23.25, like we had it yesterday. This is just saying between 2,200 and 2,500, we're going to get paid. I know this isn't very exciting for 80 cents. So let me bring it back over to Bitcoin just for our the sake of our experiment to make it exciting for our viewers. So let's see. Let's juice it up. Yeah, now they're expensive. Okay, so if we think by May, it's going to be out of 70 and 80, something like this. This is very wide. You can tighten this up, right? But this is what, 1,400? Let's just call it 1,500 for the sake of this example. In this range between 70 and 80, you get paid. Right in the middle is when you're going to get the most, which is a lot of money, right? If we bring this in tighter, we know for a fact it's going to be between 74 and 75. Which, don't do this. This is just for the sake of the example. We know May 1st between 74 and 75. We're going to be exactly where we are. Dude, this is $4,400 that you would collect. And if it's in your range, maybe it's a little bit less, but
if we stay the same, you make that much.
Yeah, but if it goes to 80K, you're losing way more than 4,000. If it goes to 70K, you're losing way more. This is just the sake of the argument, and this is one contract. So times this by 10 contracts, dude, it's 40 grand. But also on the top side and on the bottom side, you have unlimited risk, right? I hope I'm explaining it as much as I can.
I think you are.
I'm trying. So this is risky. You wouldn't sell a strangle. Also, you're like short vol, right? So you're like, even if price doesn't move and vol just falls off the cliff tomorrow or into the weekend, you can short this into weekends. This is a payoff that I think Gravity Sucks. He works for Amber Data. He used to work for GVol Greg, and now he works for Amber Data. I think he put out a thing like selling strangles on the weekend. Nothing is happening on the weekend. When nothing's happening on the weekend, it's a good play that you can play into a futures open or into a Monday open. Maybe not now because Trump is having meetings on Saturday nights and middle of the night, or for some people. So just going through and showing that you can create any sort of payoff that you wanted to create. A simple one is I don't know. I think it's going to go up by tomorrow, but below the same price in next week, next Friday, right? Next Friday. You can create any sort of payoff that you wanted. You could even create a perp with options, man. You can create a synthetic perp with options.
How does that work?
What's the price right now? So you're long. This is when you need the payoff graph, right? But let's see. You're long. You are long a synthetic is long a call and short a put. Man, there's so many to go through. Dude, there's a cool one here. We can go through two. You could do a risk reversal, and then you can do a synthetic perp at the same time, right? So we can do two different ones here at the same time. So we're gonna add 2 legs here. So the 75K. I don't know, May, right? We're going to buy at the money, and then we're going to sell the put, right? So we're long a call and short the put at the same maturity, at the same strike. You're collecting. Well, wow, puts are more expensive right now. Puts are more expensive right now because the world thinks that quantum is coming, and the world is scared about. There's a few things, right? That quantum's coming, and downside protection because of.
Do you think this is just for crypto and not for stocks? Like, are puts not more expensive for stocks right now?
We can look at the call put parity for stocks, but I think like last week, puts were definitely more expensive because everybody's buying puts, everybody's protecting downside, and then when it doesn't go their way, they need to unwind. That's what we saw in TradFi this past week, right? Like it's just been absolutely flying, right? So this is a synthetic. You're pretty much getting paid to do this because the put is more expensive, but usually that's not the case, right? You're getting paid $80 to put this on, but if it just starts going down, you're short this put, right? So this has unlimited loss on the downside, but it's exactly like a perp. It's gonna pay off like a perp. It's if we had the damn chart, it's a straight line. You know, it's either a straight win or a straight loss, depending on where the price goes. It has nothing to do with any options mumbo jumbo. Let's not get into delta or any thetas or anything, any Greeks. Your theta is $2 a day. Who cares? You know, your delta 1, it's 100% move. You're tagging in exactly how a perp would work with options. Okay. The other way to do it is a risk reversal. So you're like, everybody's buying puts. We're getting a nuke. You're like, I'm going to risk it, man. You know, we got to play around with the numbers, but yeah, something like this. The other one was a little better. Yeah. Okay. So this is a risk reversal. So you're going to get.
If you think we're going to go down.
No, if you think we're going to go up.
Oh.
One upside and you don't want to pay for it. And you know we're not going more down. Okay. So you're short the put. So you have unlimited loss here on the downside. That's not great. But let's just call this even, right? 12.34. Yeah, pretty much, right? It's going to cost $6 or something. $2. Okay, well, it moved. But this is when price is nuking and you're like, this is insane. This is some dumb news. This is Trump, you know, the taco's coming. I know it's going to go up. If price keeps going down, you have unlimited loss. But on the upside, you have everything to gain. You got a free call option. Okay. You can do it, you know, just like we did before, right? You can sell 2 and then it becomes free, or you got a call option for the difference for $1,200, right? In this example, you spend $1,200 for this call. Your theta is nothing because you're collecting on this short put and you're paying on the. We need the deltas here as well so you can see per leg. But this would be if the price is nuking. You think the taco trade's coming, it's gone too far, maybe it hit your meme line, you know, and you're like, yeah, screw it. I'm going to risk a little bit of cash here and $1,200. If it keeps going down, you're absolutely screwed. But if it reverses, you are collecting. You are absolutely collecting. You can bring this up and you know, you're going to get paid even more, but your risk is more because it's $900 away, right? And we're talking May. Risk reversals, maybe you want to look out into the weekend. You know, I wouldn't look out like, oh, I'm going to put a risk reversal on for a quarter. You know, I'm not going to do that. I would just look at putting something on for a short reversal, even a daily, you know, something that's gone too far, hit your meme line, you're sure it's going to pay off. You can do this on the way up too. So there's other ways to put on options plays and get whatever payoff you want for without just burning theta, which is time decay, kind of like a funding. Instead of just burning through time decay over and over and over again, you can build some more, some better plays here.
How much value your option is losing per day, right?
Continuously, not like a funding, like an hourly type thing, right? The other thing with this option thing that you can do with this synthetic perp is something like this, right? Let's say funding, like right now, funding is crazy, right? Okay, well, not anymore. Let's say funding's crazy, okay? Shorts are paying, right? So, or let's just say it's normal, right? Longs are paying. So let's just say this is normal. Longs are paying. Oh man, I lost a comment. No, wow, that was genius that it's still there. So you put this on. Funding's in normal range, right? Longs are paying, not shorts. Shorts are paying right now, and it's wonky because quantum, World War III, the Iran, the Middle East, the global tensions are at all-time highs. So people are still protecting downside. Okay, the play here for a synthetic position is you're long the perp, synthetic perp, and you're short the real perp, collecting funding. And with portfolio margin, you can scale up, you can put on size, your deltas are 0. All you're doing is collecting funding. So your delta 1, you have 100% upside, right? If it goes your way, you're paying $2 a day, who cares? And as long as it's not going to show funding here, but oh, nice. Thank God I had a no break. My power's going crazy. Sorry. Really? Jesus. All right, we're back.
Backup power supply?
Yeah, to the Wi-Fi too, so you don't lose it. Camera, Wi-Fi, computers, desktop, you don't lose anything. Incredible tech. So here you would the killer here is opening and closing these positions and your spreads, right? If you can get this and put this on, and this will just execute at the order book price in the Cayenne book, right? So this isn't an RFQ. I guess we can go over that after, but let me finish this thought. Your theta, you're paying $3 a day. You have a long perp and with options, and you have a short perp with a perp. You can collect funding. It's kind of like you're holding spot and you're shorting the perp, right? But this is an easy way. You can lever this up. You can put on more size than one, but this needs to match. You need to have great fills. You can click trade this, right? But you really need to watch out for your opening and closing of positions. Right, your delta 1 and your short 1 delta, right? So you're delta neutral, essentially. You're paying $2, and funding is going to be more on this perp than your $2.59 a day, right? This is a very interesting play for somebody who wants to do funding arb, so it maybe doesn't have all the money just to short a perp and hold spot. Also, Cayenne is USDC margined, it's not coin margin, so it's not like you're sitting on spot on the exchange on Bitcoin and then shorting the perp and then it all equals out, right? You have dollars here and you're shorting a perp, and maybe you have Bitcoin on a cold storage and that margin doesn't work out together, right? Because you have money separated, you have real coin on a cold wallet, and you're short a perp. Your short perp can blow up. You're not blowing up here. I guess you can lever this up as much as you want, and I'm sure you could blow up, but with a little bit of capital, you can lever this up and just play a straight funding play, especially when funding gets super wonky. It's great, right? This is just on majors here on Cayenne. There's no altcoin options, but I'm sure you could do it on an altcoin option too if somebody had the liquidity on their order book, right? That is, what do we go over? 1, 2, 3, 4, 5, 6.
I mean, if someone wants to just do an option with a perp, the covered call and covered put does that, right?
The covered call is this, like, we need to change this because it's not necessarily a perp. Covered call is like, oh, you have 1 Bitcoin and I'm short 1 Bitcoin, and I'll collect this $2,000 if it doesn't go above.
Either way.
Yeah. But this is for like a treasury, or for somebody who wants to get yield on Bitcoin, or for miners, or for people like that, right? You're okay selling at a certain price. If you're a trader and an active options trader, on the retail side, just start with a call spread. You're like, okay, I'm coming from perps, and now I'm going to come into the options land. I'm going to crush it. This simple example. Tomorrow we're going up. I think tomorrow it's going to be $500 higher on the top end, and I spent $260. So I spent $260 to double up to make $500 basically. There's no fees on Cayenne right now, so you're only going to pay 0.25 bips for insurance fund. You're not going to pay a 3 bips trade fee on your open and close. So you're able to put on these positions that are maybe a little bit tighter, or close dated, something that you wouldn't be able to put on somewhere else because of fees and on opening and closing. But you're like, screw it. I think it's going to be, it's going to cost me $10 here, right? Sorry, $250. So I'm going to spend $250 and I'm going to make $500. I'm going to double up tomorrow if it's above 75K. If not, I lose $250. Who cares? Right? I'm going to lose $250 anyways on perps funding, or on my directional bet, or on, if I just remove this short put, I'm going to lose $500 tomorrow. I'm going to lose the whole premium tomorrow. It's going to be worthless, right? At least I got a shot here if it moves $500. With this, you need 75K plus 500. You need 75.5 just to break even. So you need 76K to make $500. With the other example that I just had, you had, there we go. There we go. It's going to cost you $250, a little bit less now, $230, and you're going to make $500. So like, these are very simple plays that shouldn't be confusing or too complex for retail to pick up and go from go from perps trading into the options land. That doesn't mean that you're going to be 100% options trader. That doesn't mean that you're going to, give up perps. But it's another skill set to learn. Like, oh, I'm going to collect that funding with a synthetic long and a short perp. I'm going to collect funding. This is a huge play that you can put on, and it's a good skill set to have, depending on the situation in the market, right? You're not like me sitting on a bunch of positions, trying to figure it out, hedge it, and things like this. Like, this guy direction, I probably shouldn't share other people's positions, but this guy's down $1,000. He needs it to go to 73,500, right? 74 minus 500 on the downside. He needs 63.5 just to break even for tomorrow. This is 100% a loser. This is not going to hit. If it does, he's a genius. And he's paid theta every single day, and now it's worthless, and he's paid $1,000. You can see the guys here that did, what did this guy do? I'm down, man. So he hit, right? He hit on some call spreads. He did a 72.74. He did which he's up, right? He did a 75, 78, which he's up, right? This one and this one, he's up $100. And he did 76 and 80, which looks like I'm up because he needs it 80K by next Friday, or in between 76 and 80. I'm assuming this is what he's doing because I'm just going by the strikes and this one and this one, right? I mean, fuck, he could have did 72, 80, right? Or whatever, 72, 76. He could have built it however way he decided, but I think that's what he did. Yeah, funding's in line right now, right? But people are aping. Funding's really nice, dude. Look at this, man.
It looks normal now.
Yeah, it looks normal. It was super wonky there for a few days. I know Professor did.
ETH is trying to break out.
See. Yep.
Oh yeah, we got a little pump while we were talking. Bitcoin
Yeah,
at
it
75
was
again.
Donald Trump. I think it's because they're doing peace talks, right? So, Dan, did you have any other? Was that a good basis of the combo trade? What did you think?
Yeah, it was very good. Yeah, I mean, even I learned a bunch of stuff. Just if someone really wants to use perps, but he wants to like start incorporating options into it, like gradually, what would you recommend the most?
Call spreads, man.
Like let's say he wants to long right now, and he wants to somehow incorporate options, maybe for hedging, maybe use the perps for hedging instead.
I mean, really depends, man, right? Like if he has, it depends on the size. Like, oh, if you're long $10 of Bitcoin, options, nothing's going to help you, right?
I mean, like a decent size, like a few thousand.
No, okay, like whatever. The guy has a bunch of Bitcoin. He has spot. He has a bunch of perps, and he's like, man, I want to hold this long, right? I don't want to get out of it, right? Here you would need a little bit of calculation to figure out how many deltas you're carrying and then how many puts you would have to buy. And you see this in TradFi, right? That's why puts are a little high right now, but people are hedging their whole book. They don't want to get out of this long exposure in the Qs or SPY or maybe they hold a mega position of, I don't know, Bitcoin or IBIT or Oracle or whatever. And, it's happening, right? Everything's going up right now. Let's, just go with it. I know AI is ripping and crypto's not, right? But you can figure out, you're like, man, I don't know. I think, by the end of May, like I'm willing to spend 4K. I have this mega long on. I don't know how much long you have, but you have plenty of long, right? It's going to tell me that's too much, right? Yeah, because I'm not logged in.
Oh, yeah, the max 2 BTC per option right now.
Sure, but let's say I got like a 5 Bitcoin per position on, right? That's a lot, right? 300, 400K long, or in spot. Like, man, I don't want to close this position, man. I'm getting paid to go long by these people who think it's going short. I don't want to close this position in this perps position, but I'm not too sure if it's going to work out, and if it just comes down a little bit, I'm screwed, right? So for this, I don't know, we'll do it by next week, right? Next week. You're like, man, I'm willing to spend, it sounds like a lot, but I'm willing to spend 18K, right? 1,800 times 10 to get my 5 Bitcoin downside exposure. And man, if this perp thing doesn't work out, I'm still long, on a different exchange or on here or whatever. I'm getting paid this funding. This funding is great. It was super good, the past few weeks. But, I'm just not sure if this thing, maybe it goes to 50K, man. Maybe it goes to 0. So I'm willing to buy some. You can make this cheaper. You can buy a little bit out of the money. Here you go. That's a better example. I'm willing to spend $7,000 to bet if this thing goes to 50K, maybe you need a little bit more, right? There you go. I'm willing to spend 14 or whatever. I'm willing to hedge half of my portfolio to get this downside protection. If this thing goes absolutely nuclear to 50K, I'm covered. I'm hedged on my position, on my 3 Bitcoin position here in this sense. Sure, I'm paying theta. It's insane. But, I'm willing to, if maybe my funding's covering this, you don't know, right? Really depends on your position. But that, like, you can only do this so many times as well, right? You can only spend 7K a few times, but you're like, man, this Iran shit, this Middle East stuff, I'm just not too sure. I'm going to hedge out my position or whatever, COVID. That's what all these big shops are doing. That's like when you see these crazy options come through the tape, you're like, this guy's long $1 billion a yard, right? $1 billion of QQQ, and he just spent $20 million of premium out of pocket, 20 something million dollars out of pocket to hedge his whole $1 billion position. Who cares? Sure, it's a lot of money, but if QQQ goes up, he just made more than $24 million. And if it goes down, he just hedged his whole position for $24 million worth of premium. The notional is the amount of contracts times the spot price of Bitcoin. So here it would be 720K, but here you're only spending $7,000 to get 720K notional. So that would be the situation where a bigger player would just come in and buy like a directional put. Like, man, I don't know what the hell is going to happen. I don't want to think about it, but I know for $7,000 here, I can hedge my whole position and for the next week, and I'm happy to do so. That's okay with me because I've been riding this long so much. Maybe they got in at that 60K, maybe they're up a lot. And they're willing to. You can even go crazier. You can go super wingy. You know what I mean? Like, you can buy tons of this and get exposure. You can have 100 Bitcoin exposure for nothing, for $3,800. Like, if this thing really was to go to 40, 50K, 30K, like, you can get a crazy position and options to hedge out. Doesn't need to be right at the money because it's too expensive. This is too expensive. It's $1,300, but sure, you can hedge out a little bit. This is a little wingy on 60K, but you don't need to. This 38K, if it did go nuclear, I don't know, you have a 5 Bitcoin position, you just spend nothing to get some crazy downside. Yeah, and if it goes nuclear, you're hedged. But you can only do this so much. This cuts into profit. Hedging cuts into profit. If you really are just retail and you really are just trying to pick a directional bet, pick a simple call spread, tighten it up, 74, go a $500 range, go $1,000 range. Here you spend 180 to make, 280 to $200 to win, Jesus Christ, $300. Wow. To make 1,000. Okay. That's great, man. That's a great trade. Like, people forget that you can create these payoffs. Sure, you spent a little bit of money, 280, but you made 1,000. If by tomorrow it moved $1,000, like,
for this range, it's not bad.
Yeah, especially if it's range bound like it has been for a while, right? You don't want to sell options if it's your first day. You don't want to take on too much risk. You're really coming from perps, and then you want to take directional plays. Start small. Start with these tight spreads. Paying out a little bit of premium, a little bit of debit out to get. This is nothing, man. It's $200. $200 to make 500. It's great. It's a great return. Especially on a daily, let alone a weekly or something like this. And if this is scary to you and too expensive for you, come to ETH, do a call spread. It's $10. It's $15. It doesn't have to be scary. It's $15 to make 25. Doesn't have to be too big. Doesn't have to be too scary. It's just compounding wins and things like that. That's what I would tell perps traders coming over. I know I went on a little rant there, but That's what I would say. Should we do a weekly or a
I'd say-
bi-weekly? A bi-weekly?
Sure.
Updating the
What are we
book,
thinking?
seeing how everything looks. Yeah, whatever. Monthly? I don't know. Are you guys raising the cap? I know that in Cayenne right now there's a wait list. It's 200 people, I think. Max deposit's 20K.
Yeah, it's more now, but we're letting people in
As they trickle in.
as they go, and we still have the invite codes. If anyone listening right now wants to start trading and you don't have an invite code, then you can DM me or Marty or Cozy, any of us.
Yeah,
even the official
or tag me on Twitter, dude, or in the post, because, dude, my spam, I just went through it. I had like 500 messages. 50 of them, of course, half of them are negative, bad things, right? Spam. But 50 of them are like real people reaching out for codes, real people asking about options, real people wanting to connect. Dude, somebody hosted an event in Rio, 2 events in Rio. Like, man, like I missed a bunch of stuff by their stupid spam filter.
They really changed the layout of the DMs.
And these people follow me, man. It's not like random people. Yeah, it's like, yeah, it's bad.
They changed the layout of the DMs on Twitter again.
Yeah. So,
all right, this was a really good overview. Unless anyone has questions, which you can write in the chat, I think that's it, right?
That's it, man. We're here. If anybody has any questions, we're always here. Denton put some stuff in the show notes, and that's it.
Yeah, very good.
Alrighty, thanks, guys.
How much did we get up to? 500?
500 or something.
Yeah.
Cozy, I'm gonna text you to wrap it up. Was good, man. Was good. Cozy, help.
Cozy.
I think he's running back to the computer right now.
There we go.
Oh, we had a bunch of questions, man. I didn't even see. Evino said cash settled or asset. Yeah, it's all USDC margined. Little Quan says 64K player gonna hit tomorrow, believe. So.
You think?
No. That's what Little Quan said. 11K move. He actually needs like a 12K move by tomorrow just to break even. That's the problem.
We would need another war. Maybe 2 more.
Even then, I'm not sure. I'm not sure that you get that, right?
Actually,
yeah. No, I think it's just, like, dude, looking how every dip is just getting bought up. Like, at some point, if you're wrong, just like a perps trade, right? You just close. You just close the damn thing. You were wrong, so close it. If there's still premium left, I never got this. Like, some people would just rather ride it to zero. It's like, man, there was still $500 worth of that thing a week ago or whatever, 5 days ago, 4 days ago, and then you just rode it to zero, like, just in case. Like, dude, 62K or whatever, 64 was like a new low, pretty much. Like, after this end of the March thing was like 65 even. Like, you just aped the bottom. You really needed a huge move. So that's it for me.
yeah, thank you very much, Marty.
I got to do some other stuff today. Cozy, end it. I don't have admin.
Yeah, I don't see the